So the question is this a signal for bottom fishing? Joining me now to discuss MaxFunds.com's Jonas Ferris, the chief strategist for Money Map Press, Keith Fitzgerald, and from Kingsview Asset Management, Scott Martin. Keith, I want to start with you because you were uncommonly un-Keith-like bearish. You were sort of nagging and gnawing, and you were just sort of ornery the last couple of weeks. I'm seeing signs of perhaps a little bit of bottom fishing happening here. Could that be the case?
You know, I was ornery for a reason, and yes, I think a bottom is being put in. I'm still cautious, but we have a market shift from optimism to pessimism on retail investors. We have 175 hedge funds that have blown up in the last quarter, according to a report I saw just before coming on the air. That tells me we've got potentially a great contrarian sign. When everybody's scared to go swimming is the time you start putting your toe in the water.
Scott?
I dig it, but I don't think we're there yet. I'd like to see a little bit more Payne, not P-A-Y-N-E, but P-A-I-N, about, because I definitely want to see more Charles Payne every day. But the reality is this, Keith's onto something, though, Charles, which is this sentiment. It is this blowout of the hedge funds. It's some of the big down volume, Charles, that we see, even on a day like today, you know, where the markets are up, they were sanguine, and now, you know, the NASDAQ has turned over in some areas. So, to me, this is part of the process, but I do want to see one more rough day, one more test of those lows from just, say, a week ago or so, just to make sure that that is a firm bottom, because those, if they don't hold, by the way, kids, are going to probably lead to more selling, just at least by the machines.
And by the same token, that's one of the arguments, is that we keep hitting these support points and we keep holding. One thing I look at, guys, is the breadth. Now, we know there's a few ways you can measure that, advances versus decliners, up volume versus down volume, but also new 52-week highs and 52-week lows. Now, the highs haven't changed much, but last week today, on the New York Stock Exchange, there were 648 stocks that made 52-week lows. Yesterday, there were only 128. Jonas, it feels like maybe somebody might be in there trying to just pick at some of these stocks. I'm talking quality, value, new blue chip names that might be oversold.
I think this stability and bottom that's coming in, it only came in because interest rates dropped. The 10-year went below 3%. That made stocks sort of cheap again with the correction that they've already had. But it's not like these. Look, the tech stocks were more than 10% overpriced. So a decline like that doesn't make it the bargain of the world. And another thing you have to watch out for is, you know, like 2000, when tech stocks were down 10%, they weren't a bargain. The money was moving out of that into value, into different areas abroad. And you want to do your bottom fishing not in what was the hottest area just because it's down 10%. I don't think it's. I think we could see NASDAQ 5,000 before 10,000. And I think if interest rates creep back up over 3%, this market's going to fall apart again.
You know, Keith, on that idea of contrarian, you know, sort of going against the grain, you mentioned the professionals, but according to the American Association for Individual Investors, bearishness now at 49%. From what I can see, this is the highest level by far of the year. So finally, individuals are just completely away, only 20% are bullish. Is that a contrarian indicator for you?
Well, it has been historically, because 85%, other research shows that 85% of all buy-sell decisions are made incorrectly. And as you and I both know, the individual tends to buy when they should be selling and sell when they should be buying. Now, the professionals haven't done much better, but that doesn't change the fact that over history, people to do exactly the right thing at precisely the wrong time. And if you're an investor, you've got to take that longer-term view. You've got to look for the quality companies. And that's what markets like this are all about. Even if we get another bout of downturn, which I hope we do to clear the pipes, because then it really is clear sailing.
You know, but by the same token, guys, I mean, this whole idea about, you know, precisely picking the bottom is a little bit of folly, right, Scott? I mean, so if there are value names out there and you are an investor, not necessarily a trader, you've got to at least be spying or creating some sort of a potential buy list here.
Yeah, I mean, you really put it up correctly there, Charles. It's the trader versus the investor. And you don't necessarily, if you have that longer-term horizon, let's face it, which is 1, 2, 3, 5, 6 years, maybe picking the bottom isn't exactly in your best interest because it's going to be a hard thing to do. Jonas mentioned something really apparent, which is look at what's happened to interest rates over the last few weeks. I mean, even as the market has tried to stabilize, rates have come down. Yeah, that's in response to the Fed, which has gotten surprisingly more dovish. I mean, look at Fed fund futures rates for next year. There's as good of a chance of, say, 1 rate hike versus 2, and even a chance of 0, believe it or not, all of a sudden when we had 4 chances, say, just a few weeks ago in 2019. So the market is telling the Fed something, or maybe it's telling something about the economy we have yet to see come through yet, which is why stocks, I think, are having the trouble to, say, break those recent highs.
Guys, Harris Faulkner just had a great interview with President Trump, and they covered a variety of topics, including the stock market. I want you to take a listen to what he said will turn this market around.
What is your strategy, if you will, for bringing it back at this point?
Well, I have a very simple strategy. We were up almost 40%, and we lost a little of that because of trade. I mean, I'm doing great trade deals.
And you're willing to do that. That's different.
Yeah,
is
well,
it
I'd
risky?
rather do it when we're up 40%, and now let's take a little bit off the table and fix it, because we cannot continue to lose $500 billion a year to China.
So, Jonas, I love, first of all, when Harris said we were up about 35%. He corrected her quickly. No, 40. I thought he was going to say 40.089, 336045%. But anyway, he kind of knew the number. You know, he understands that, and I think this is one of the reasons he calls out the Fed as well, that the main pressures on this market are as much psychological, having to do with the unknowns, than the knowns, which are great. The economic data is great. This morning we were greeted with the initial jobless claim that was the biggest beat this year at 49-year low. The economy is great, but the market's not reflecting that.
Speaking of the psychological thing, a lot of the drag is just that. Is it, okay, it's been a bull market for so long, it's come up so much, it's got to break at some point. That's in people's head. And then this whole thing with the yield curve flattening out, that has been bad in the past. It doesn't mean it causes recessions, but because it's got a high degree of accuracy, you know, one skirt lengths for a high degree of accuracy, investors still have that in their head. They're like, this is it, I got to get out. And the president was basically right about interest rates earlier this year. They were going up a little too fast, and it was hurting the housing market. It was going to slow the economy. It already slowed some of the economy. That was more of a drag than the tariff war at this point. As for his overall point, you know, the foreign markets are down more because of the trade war. If you look just at stocks, we're winning the trade war at this point. It could give investors an opportunity to actually go into China with money, because that market's down so much. It wasn't a hot market before.
Sure.
Like biotech or tech, and you can actually get some high dividend yields going.
By the way, the China market is down significantly, going back to the high of 2015, folks. I mean, if you really talk about oversold, they're extraordinarily oversold. So let's talk opportunity, right? Because that's what we like to do here. You guys, you make a living seeking and finding opportunity. Even if you weren't, Keith, to pull the trigger today, there's got to be some things you're looking at in terms of bottom fishing or something oversold.
Well, there's three that are right in my mind, in the wheelhouse for everything I think about. Boeing, big defense contractor, huge backlog, lots of money flowing into that stock. Last time I checked, people are still going to fly, even in a slow growth world. AbbVie makes the largest arthritis drugs in the world. Huge chain, 4.91% dividend, so I'm attracted to that because it's security in the face of uncertainty. And finally, NVIDIA. It's all about AI. That stock has been beaten mercilessly. I think it's going to take a quarter or two to work through their numbers, but this is one of those things that few years from now, I believe you're going to be kicking yourself if you don't own it. You
know, you mentioned two of the four names I put on the show last night and offered to the viewers free on my website. By the way, the report is up there. It's wstreet.com. NVIDIA, I first played that stock in 2002 at 15 bucks. I wish I held it and never looked back. And Scott, you know, I think sometimes that's what investors do, right? They kind of get involved in these crazy gyrations. They sell great names, and they will look back. People are going to look back a year from now, 2 years from now, 3 years from now and say, golly, why did I sell that stock? Are there any names that you're looking at that might fit that bill?
Yes, and to your psychological point, Charles, and I deal with it too, working with individual investors, they don't tend to go into these positions expecting pain, you know, P-A-I-N, in the sense of like realizing that, yes, NVIDIA is a great company, but sorry, there could be a 30% drawdown, at which point, if you still believe in the company, you should be adding to those positions. So, yes, quickly, Charles, I do like the energy sector. Similar to Keith's points, you know, it's been absolutely smoked. AMLP is an ETF of not the drillers. We're talking about storage, transportation, processing, pipelines. Those are areas where I think they've been thrown out with the oil prices. They've been thrown out with crude. It's got a great dividend on it, about 8 to 9%. It's 10.99 income and coming out of a 3-year bear market.
Master Limited Partnership. And real quick, Jonas, anything for you?
Look, Trump took the Chinese market down, and eventually the trade war is going to end. And at that point, it's going to be too late to get into Chinese stocks. So you want to go when it looks bad. Franklin just launched some new ETFs. The Franklin FTSE China ETF is 0.19%. They're all expensive, the other ones. This is the cheap way to collect those dividends. very out of favor area right now. This is going to outperform the U.S. market.
Are they focused on some of the big names like the Alibabas
Yeah, it's all
of the
Tencent.
world?
It's all market cap weighted, but you get it so much cheaper than the competitors. And, you know, this country, China might benefit from easing up their protectionist strategies and their tariffs. They need to be more of a free market. They've gotten big enough where they can now be more like America and go into their next wave of growth. So it actually could benefit them to get out of all this behavior.
You know, it's so funny you say that. I tell people all the time, the irony of all of this is they say they want to be a domestically driven economy and not rely so much on exports, and some of the demands we're making fit right into what their long-term goals are.
We might force them to make improvements that they need to make at this stage.
Later on in the show, folks, we'll also tell you.